start with your own capital because whilst it is partially a validator, it's also ironically less stressful. At least it was for us. I think that means it's because our heads are in the right place, because it means, it's our money, right? And if we lose our money, it's our own fault. It completely changes the dynamic once you start putting other people's money in play. There's certainly a higher level of responsibility to make sure that everything that you're presenting is what will materialize.
Hey, what is up, everybody? Welcome to Go Big Live Real Estate Investors Podcast. I'm your host, Matt Drouin. I am actually psyched out of my minds today to have two special guests here. First time we're doing a one-on-two interview, so we're doing some experimentation here to and see how it goes, but I'm really excited about it. I have the co-founders of Simcap Holdings, a multifamily asset management investment firm that is at now 212 units. They're actively raising for a fund, so definitely check the show notes to get on the distribution list to learn more about that. I have co-founder Ross Metz and also Josh Goodwin. They're based out of Cincinnati, Ohio. And I am really glad to have you guys on the show. Welcome.
Thanks.
Thanks for having us.
Thanks for letting us be the guinea pigs with the two of us.
Two heads are better than one, right? That's why partnerships are so powerful. So
Right.
I want to start off. I'm going to actually pick on each of you one at a time, right? So Ross, I want to ask you a question. You were born and now you're here. What happened in between?
Yeah, so I was born and raised in Cincinnati, Ohio, west side of town. If you know anything about Cincinnati, there's an interesting east-west kind of rivalry, if you will. So I was here up until college, moved away to Columbus, Ohio, where I went to Ohio State University, lived there after college for a little while, went to college, got my accounting degree, went into public accounting after college, where I spent a little over 3 years. I did get my CPA. After that, I worked for General Electric for a little over 5 years. So, I was working in financial reporting, financial analysis, accounting type roles, kind of continuing on with that accounting background. Then we moved, my wife and I, she works at Procter & Gamble, we moved away to Seattle, Washington, where we spent about 2 years. There I worked for a smaller aerospace manufacturing company as the corporate controller. Kind of throughout this time, that the corporate world working time, that's when I was buying personal real estate, really just as a diversity play. I didn't necessarily have the intent to move into real estate full time when I started, when I first started doing that. But as the wheels kept moving, I really developed a passion for it. Kind of have an entrepreneurial mindset background. Always knew that I didn't want to spend my entire professional career in the corporate world. So with all the shifting back and forth between Cincinnati, Seattle, different jobs. So we moved back a little after 2 years from Seattle. I took another role, another corporate job in finance and accounting. And, it just kind of was the impetus to kind of move things along and really, take them steps to start my own thing and develop my own company. Just with the real estate background that I developed over the 10 years of working in the corporate world, just kind of was the natural progression. And that's kind of how I met Josh, and I'll let him go more into that. So 2 years ago, not that I'm counting, I think it was March 18th was my last day of in the corporate world. That's when I took the jump and moved into real estate full time. So then I guess over the last 2 years we've been working together. And again, I'll let Josh kind of go more into detail on how we got here.
Yeah, absolutely. Josh, same question, man. You were born, now you're here. I imagine every great partnership is diverse in its nature, from skill set and background, that sort of thing. We're talking in the green room. You definitely don't sound like you're from Cincinnati, Ohio. So tell us about where you came from.
Originally, I was born in England. I lived sort of sporadically around different parts of Europe. And then I moved to Cincinnati actually when I was younger. My parents, my father used to work for Procter & Gamble. And like all roads tend to lead to Cincinnati. At that point, it's the headquarters for it. So we ended up here. So I spent my high school years here. Then I moved from Cincinnati, went back over to the pond to Europe. I went to the University of St Andrews, which is in Scotland. I'm not a good golfer, though, before you ask. I wish I had taken golf more seriously when I went there, to be completely honest. After that, I actually had a green card from my time living in the United States, and it was kind of on its last year or so before it expired. And it's a pretty powerful piece of paper. I didn't want it, and much to the frustration of my girlfriend, but now my wife, I did move back to the United States for banking. And there were all these kind of interesting cities that were sort of I was slated to go into, but then your banking is so relationship driven that that they found out that I used to live in Cincinnati. So it was like, boom, how do you feel about Cincinnati? Which originally I wasn't thrilled with, but it's turned out to be a super big, super large blessing. So very grateful for that looking backwards. So I started here in private banking, and then I moved a couple times before leaving to start my own company in real estate, which was a smaller investment and residential agency. So we had a team of agents, and it's a pretty standard model. All went out, sold houses or investment properties, and we worked well together as a team. And then right about the time that I was getting ready to exit and sell that and focus more specifically on commercial real estate in some means, I was really looking for a partner to do that with. I loved working with partners. I think you mentioned it already, Matt, that like there's a lot to be said for having diverse background in your team and make sure you're bringing different skills to the table. As Ross already hit on with, he knows the exact date that we were formed. He's very much a detail guy, and that goes a long way for keeping us on the rails. And so we were actually working together in a client-agent relationship at the time, and Ross was buying a number of really strong investment properties. And we just became friends through that process. And when I got ready to jump ship, we sort of had a conversation and said, hey, what about if we made a big commitment out of the gates and started working together like full time at this? So we sort of set a runway of when Ross was kind of ready to leave his corporate position. And I think we stretched just about every bit of lending capacity out of Ross while he was continuing to be employed, because it's much harder to get financing once you stamp yourself as self-employed. And so then once he left somewhere around
March 18th.
March 18th, that's right, 2022. And then we've done this full time ever since. So we kept buying larger and larger assets with our personal funds up to the point where we sort of felt that we need to start either sharing this with others and at the same time protecting our own personal assets in case something were to go wrong. We can't have $5 in our bank account. So we then moved to a model, that's very common, which is syndicating individual deals. Got some great stories from that. And then most recently we just launched our first fund. So we launched that just start of February. So we're really just getting rolling on that. That's kind of how we got to this position here. We're in our offices right now in downtown Cincinnati.
Excellent. I want to back up a little bit, Josh, because I'm a former real estate salesperson myself. Okay. What was the seminal moment that caused you to jump or want to jump from the sort of like the, cushy, consistent paycheck associated with what you're probably getting in private banking to the crazy world of, of real estate brokerage?
So similar to Ross, while I was in banking, I was doing real estate deals on the side. I met someone who we ended up forming a partnership together, and basically I provided capital, and he did flips, and the largest one we did was a triplex, so pretty small assets. But I was getting exposed to it through that, and I really like the tangential nature of real estate. Right, it's really, you can see it, and it's more valuable to me. It's more exciting than just numbers and digits, which is what the banking world is all about. So the impetus, I suppose, was I was already kind of comfortable with the concept of it. And I thought that there was a lot of opportunity to do it better than what I was seeing it. I didn't necessarily have to be the best in class, but I knew if I put all my time and energy towards it, we could do pretty well. So I jumped ship, and that was seven years ago now, and that I left the corporate world. But I've never looked back. And now the idea of going backwards and working for a company is really sickening.
So this show is about really diving into excruciating detail, your first big deal, or it was big to you at the time, and the things you learned doing it, the mistakes that you made during the process, sharing those war stories and battle scars in the process there. And we had talked in the green room about the case study we wanted to make for today. So tell me about that story.
Let's do Clarion.
Yeah, I think Clarion's the best one.
I'll tee it up.
Okay.
So the deal we're discussing is our first ever syndication. We've done equity deals in the past. Those are easier. Syndication's a different beast. So there was that, bit of angst going into it. And in addition to that, it was in a rougher part of town, to say the least. I think the street was deemed the nickname of Crack Avenue. And then to highlight the deal itself, is a 30-unit building right near Xavier's campus, which is a local university here. And we had gotten some word and some, I guess, insider trading, if you will, of some development that was happening in the area. So we knew it was going to be a good investment. What we didn't know was how difficult it was going to be to get there, and how much we'd have to roll our sleeves up in terms of getting involved in some of the local issues, if you will. Full scale renovation, inside and out, every unit, common areas, exterior, new windows, you name it, it needed it. I think that's a good tee up.
Yeah. So from there, and what Ross is talking, I think the thing we're always ready to underestimate the cost of a renovation, right? Like we go in there, we build large cushions in, more significant than I think other people do, because we've been through it, and like, it doesn't matter what number you put, you're going over it. So we knew that going in, we were ready for it. I think what we weren't prepared for was the challenge associated with the tenant, was moving some of those tenants out. And it ended up presenting. We have a number of things that are interesting about it, but one in particular was a unit that became occupied by a number of, let's just say, shady characters, and we don't really know how they got in this unit. There's someone came out of it, and there's some stories that there was a key left in the door. We don't know, but there was a lot of them that made their way into this unit, and
12 to be exact.
Yeah, 12 people that now made their way in. And our property manager went out there with the police at one point, and the police, they wanted him to kick the door in, right? He basically said, no, I'm not kicking the door in. I don't want these guys to see me. And then to make things worse, you'd hear guns being clicked and loaded on the other side of the door, which is just really, you don't want to kick a door in if you can hear that on the other side. So shockingly, they just ended up like leaving. The police just left, and our property manager came back to the office, and we basically were like, okay, what do we do now? We've got these people like in a unit, and we've got to get in there, because we can't have people just living in our building, especially dangerous people. We didn't know there were 12 of them at the time. But so I don't know if it was a combination of Monster energy drinks or what it was, but we decided to just go and take the unit back ourselves. So the next day, I think early in the morning, we went out there. I think I even took so we parked further down, like way down the street, and I took my drone, and we did sort of like some Call of Duty style evaluate, like flying over the building to see if we could see anything. They were in a basement unit, which didn't help. I don't know what we thought. Maybe we thought they'd all be on the roof. That would have been easier, but they weren't. Didn't feel anything. So then we went. Ross. There were four of us. There were two property managers and Ross and I. I think Ross was armed. One of the property managers was armed, and then one of the property managers disappeared. He just sort of when we were walking towards the building, he vanished. And then me, and I was wearing a body cam. And we just walked to the unit and like banged as hard as we could on the door. And you could hear rustling in there. And Ross is standing behind one wall, and the property manager standing behind the other wall, both with their guns drawn. And I'm just banging on the door with a body cam on, hoping that, I don't know, the power of some entity will stop me from being shot. And my bangs don't get any notice. And then Ross swings around the corner and like smashes the door with his fist. It's like yelling, "We're not the police, we're the owners. Like, you better get out," in words that sound somewhat like that.
I think there was an ultimatum. It was, you can either leave peacefully or we will kick this door in and get the police involved.
Oh, you said, I think he said 90 seconds or a certain number of seconds or something. And whatever time period he gave them, it was the longest period I've ever stood outside of a door waiting for what happened. And then, first, thankfully, they opened the door and, they decided just to come out to make things easier. But they just kept coming and coming out of this. Some guy in a wheelchair came out, and this is a unit that's a basement unit, so you have to go downstairs. So they're helping him carry him up. We feel weird, so we're like, should we offer to help carry this man out of this unit? It was just a really strange and adrenaline-filled afternoon. So that's a good example of like really getting into a property and being like, okay, there's nothing passive about real estate. Like it is a farce that it's a passive industry. You can get there at a certain level, but you got to be willing to put up with a lot of non-passive things for a lot of time before it becomes truly a passive investment, right? So that's one of the stories. We've got a laundry list of them.
Now, these types of things are like what builds your character, right? So you guys had a sting operation. I've had my own sting operation as well. Is when I found out one of my houses where a tenant hadn't paid in 2 years had it for sale on Craigslist for $45,000, and this house is worth $150,000 all day long. And so I set up a sting operation with my property manager. Like I went on Facebook Live to like catch these people like in the act. Like we were like, yeah, we want to buy the house. We have cash. We're ready to go. Because these people were just collecting like cash deposits from people that didn't, they couldn't afford to lose that type of money, right? They're like, right. Oh, give me $500 cash, and then I'll have my attorney drop the paperwork, and then the house is yours, right? So definitely some things that I've done as an operator. I'm looking forward to the day where I get to be a passive investor in a real estate deal, so that I can just let guys like you do what you do in the process. So I want to back up a little bit. So how did you find this deal specifically?
Yeah, it was through a broker relationship. We had bought a property previously, and we made a point to stay in touch with this individual. And through that constant, connection and touch point, it just came to fruition.
And that was a number that we didn't want first, right?
Yeah, we put in an offer on it. They countered it. It was a little bit higher than we wanted, and we kind of just let it, move along. And then we circled back and said, "Hey, are they still interested?" And it ended up working out.
So in regard to the relationship with this broker, right? Like you had the track record of closing a deal already. What was your like system or methodology for, and what do you do continually now to keep in touch with your broker contacts to get deal flow?
Yeah, I mean, we maintain lists. We have a number of different lists. We have kind of like scheduled outreach, formal and informal, depending on who the individual is too. I mean, like if there's somebody we're comfortable enough going to a happy hour with, we'll do that kind of stuff. Or maybe it's this particular broker likes to operate out of town a lot. It's just giving him a call, just seeing how he's doing, connecting. They're making money when we're buying things, so it's not like we're asking for, it's not just a one-way street, right? So there is a benefit on both sides. So we don't feel shy about reaching out, that's for sure.
No. And phone calls, I would really argue, are better, right? Like, yeah. It's so easy to send emails. People get confused as to why they're not getting traction on developing a relationship. But there's something to be said for speaking to the person. So I think we're pretty good at that.
So when you get them on the phone, is it just like hey, John, do you got a deal for me? Or like, how does that sort of conversation go? Because I want to tease out like, because I know what the answer is. I mean, what's worked for me in the past, right? But I want to hear it from you. Like, what's it like? Kind of like, what's your script? What's your script? There's probably not a script. It's probably more organic and that sort of thing. But tell me about that.
Yeah, sure. So it's different when you first start. I mean, like the outreach to this, we'll just speak to this particular individual. The first outreach was an email saying like, hey, here's who we are. Here's what we're doing. We're interested in developing a relationship, mutually beneficial relationship. That's very important to let them know that it's not just it's not only for us, right? And then as it develops, it's just easier to pick up the phone and call them and say, hey, so and so, how you been? It's been a while. How's the market looking? What are you seeing out there? And then we're actually to the point where we're selling stuff. So it's like, you're a broker. We're interested in selling these 3 properties if you have buyers. So it organically, moves from a kind of a rigid relationship to more of a personal, friendly relationship, particularly when you're offering a benefit to them.
Yeah. It becomes an advisory capacity. Everyone loves to give advice if you rely on them. So if you can make an ask of something that, even if you really have an opinion drawn up yourself and it's not particularly open to flexing, asking for their input and advice validates them as a professional in the category, validates them as individuals that you care about. And so it's just like basic social skills, really.
Yeah, I mean, 100%. I mean, I'm actually surprised that, brokers really don't, a lot of commercial brokers don't have complicated or complex CRM systems that they use. You kind of have to like stay in their face and keep that connection active so that you maintain that top of mind. Because I can't tell you like how many times like I've touched base with a broker who's been telling me for months that there's absolutely nothing in the pipeline that fits our criteria that they're abreast of, right? And then I'll call them and they'll be like, oh, you know what? I just walked a property a couple of days ago that the owner is looking to do a disposition on and that sort of thing, and it might be it might fit your criteria and that sort of thing. So. It is a lot of work and part and parcel to like the value of partnering with active operators is because they're the ones that are actually putting into the work with this relationship-based business. So I want to take a step further. Like, can you tell me about the total capital stack on this deal when you eventually landed it?
The one that
Clarion?
The takeover, the hostile takeover.
Yes, the hostile takeover deal. Yes.
Yeah. So it's 30-unit building. It was 2 million equity. I'm sorry, 2 million acquisition price. We had to raise $575,000. I think there's 5 investors on it in total. We did a traditional syndication. I think we did a 60-40 because it's a heavy value add. I mean, that's another aspect of that story. Really sharpened our teeth on the value of an order of operations and proper budgeting and
rock solid contractor contracts.
Yeah. So 60-40, and then we do have an IRR hurdle. I don't even remember what it is. I think it's 8. No, it's higher on this one. 20% IRR hurdle, again because of the value add, and then we do a 7% pref on that one.
We're also in the deal as well.
Yeah,
our company.
Absolutely. So this wasn't the first time you had raised capital because you'd done smaller deals, that sort of thing. But the first time you were doing a syndication model, what was the sort of order of operations in terms of your contacts to your investment partners? Were these people that you like all 5 of them you had done deals with before, or were they brand new, or were some of them brand new? Tell me about like the capital raising process and how that actually looked specifically on the deal.
Some of them we had done deals with in the past, and some of them were new. We found that leveraging the experiences of people that had done deals that were smaller with us previously to validate for new investors that we would take it seriously and actually know what we're doing. Mm-hmm. That was a big piece of that as well. So yeah, I mean, I think it was, like I said, there's only 5 partners on it, but
Yeah,
Most of them were
network contacts
new.
that, yeah, new investors, but like within our network contacts that kind of maybe have a bit of a partial or a bias towards real estate. I would say
Hmm.
maybe not all of them, but some of them. Like we have a couple on there that we knew like they would be interested in this deal for particular reasons related to either the area, they're familiar with the area, or they like real estate in general. So yeah, there's a bit of madness to the method to the madness, if you.
I like the first one.
Yeah.
So tell me about, there's some people listening to this who have never raised capital before in their entire life. They've kind of bootstrapped their entire way. What's your methodology for, I guess, rewinding back the clock maybe to when you guys first rose capital and developed these relationships that provided the social proof to make it easier for your job in raising capital for this deal? Maybe it was easy, maybe wasn't, but we'll get into that. So kind of tell me about that in terms of like your process and how you establish these relationships.
Yeah, I think one of the main things is showing that we bootstrap the
Yeah.
first 80 units or whatever. I
Do it
mean,
with your own money
all
first.
of our own money. I mean, that right there shows that you are a believer in the industry, real estate, multifamily, the market in general. Everything we owned was, was within the greater Cincinnati market. So that helps. And then it doesn't hurt when you have a beautifully presented pitch deck and a good return structure. I mean, that helps.
We combined as many things that we could do as possible from looking at entities that had done it at a larger scale and just tried to soup it up a bit.
Yeah.
So maybe I think we were coming in above the expectation set for other people in the same like competitive space as us, and I think that went a long way to getting people to convert. If you're sort of a cut, and it's at risk of sounding egotistical, it's relatively easy, right? To just look at what kind of offerings are being made, and we have other people that we wouldn't consider competitors, just people that are in our same space that we reviewed their material and just kind of found a way that we could present it or design it, including the return structure and the marketing material that was just a little bit improved. I think that went a long way to getting capital to come in the door.
Gotcha. So bootstrapping your first 80 units definitely helped a lot.
Mm-hmm.
How did you know who to contact when it came to your first raise, when you were raising capital to establish these relationships for the hostile takeover deal we're talking about?
I think so if you're going to put them in order, right, you start with your own capital, because whilst it is partially a validator, it's also ironically less stressful. At least it was for us. I think that means it's because our heads are in the right place, because it means it's our money, right? And if we lose our money, it's our own fault. It completely changes the dynamic once you start putting other people's money in play. There's certainly a higher level of responsibility to make sure that everything that you're presenting is what will materialize. So that first, and then finding, then you go to the friends and family route,
Mhm.
hopefully with maybe a couple deals that you can use as examples. And then past that point, before you start jumping to networks that are really out there where you might not have any connection whatsoever, the asking friends and family to make introductions on your behalf, or
Mhm.
an even more compelling way to do it is to ask friends and family members about people within their network who might know people. So you're not going to that person. You're going to that person and saying, hey, like you were identified as someone that knows a lot of people in this space. You might have friends that are retired and have passive income. You may have whatever. And making them kind of a hero in the raise process. So asking
Mhm.
them to introduce you, I think you have a higher likelihood of getting that introduction oftentimes than when you go to a friend and ask them for an intro, because they might just say like, well, I forgot. And they're like, damn it. Okay. All right.
So in the process of asking friends and family of who do they know in their network that might be a good fit for this opportunity you have you ever converted one of them and be like, actually, you know what? I would be interested in learning more about this and potentially participating in it.
Oh yeah. Yeah,
Yeah.
we have.
I think it initially, most of the times, it starts kind of like, are you interested? If not, do you have people in your network that would be interested? That's typically how I approach it.
Yeah.
Then it kind of takes it takes pressure off of them to feel like they should commit. I mean, not that people are just going to feel like they should give you six-figure checks or anything, but if you give them kind of the out on the back end, like, no, I'm not interested, but I do know so and so,
Mm-hmm.
feels like they provided something.
So you had 5 investors, and then kind of like what was like the contribution amounts here? Are we talking about 5 at $100,000 a piece, or was there like kind of a hodgepodge of different contribution amounts?
Yeah, I think it ranged from 30,000. Yeah, 30,000 to 170,000. So it's kind of all over the place.
So let's fast forward the clock here a little bit. You had to secure financing on this. It was a $1.5 million loan on this property.
Yeah, I think we got 80/20, so 1/6, whatever the change. Yeah.
Okay. And then did both of you had the balance sheet to be the guarantors on this debt, or did you have to bring in like a key principal or somebody else that had the balance sheet for it?
Yeah, so far we've been able to sign everything and I haven't had to bring anyone in. So I'm thinking that time is coming near, but we'll see.
Haven't had to do it yet.
Well, that's the position I want to be in eventually, because that's like total baller status, is just coming in as the key principal and having the balance sheet, and then just signing on the loan on a non-recourse loan. And if you partner with great operators that aren't going to trigger bad boy carve outs on Fannie Freddie agency stuff, then it's really it's as close to a no low risk or no risk type of investment you possibly can make. So.
It's an expensive signature for sure.
Yeah, absolutely. So you closed on this thing, you had the hostile takeover and that sort of thing. Kind of bring me like full circle through this thing real quick before we jump into live Q&A with our live studio audience.
Yeah, we bought it April 26th of last year, so it hasn't even been a year yet. I think we started tenant turnover. We didn't really start that till July, probably.
Yeah,
there was some natural attrition that units became open that we started flipping. But we did kind of like the first wave in July. That's another, learning point. We shouldn't have waited. It should have just been like everybody gone at once, because I think we kind of did it in waves, and maintaining the current tenant base. I think a lot of the issues were with the current tenant base. We talked about, local individuals. I think that was kind of precipitated by some of the folks that were living there already, but nonetheless. And then we finished renovations probably in December.
Yeah,
around December. There's always
we were pretty far in the leasing program before.
Yeah. We started leasing in October while we were wrapping up renovations. I think we pretty much completed everything in December, with the exception of we let two legacy tenants stick around who are now gone. So we're actually wrapping up the very last unit renovation right now. And we have, with that obviously is one vacancy, and then we have one other vacancy. So we have 28 of the 30 fully renovated and fully leased. So we are just about fully stabilized. I would argue that we're pretty much fully stabilized in January, probably beginning of February.
Absolutely. So what's the business plan from here on out? So it sounds like you're getting, you're at the point of stabilization. Are you bringing this thing back to the bank, or are you just kind of letting the equity ride in it with your investors and then do disposition at some point in time in the future?
Yeah, we're analyzing the refinance option. We're getting looks from third parties in terms of buying it. We basically have a number that if we get it, we would sell it. And I think we're getting fairly close to that number. We might have a little bit of work left to do. So we are analyzing that angle as well. We're analyzing the refinance angle. And then, as you mentioned, this thing is cash flowing like crazy. So it might just be ride that out for a little while longer and then sell it. So we don't really have an answer for you yet, but we are analyzing every angle at the moment.
And we obviously had terms in the original offering memorandum that we put out there when we raised the money. So we want to do right by that as well. So it's being able to operate without surprising anyone that was involved, which we're considering as well.
Yeah.
Yeah, and as Ross mentioned before, we had inside information about some announcements that were going on around the building, which were quite significant. It would add a lot of value to it, and that announcement came just a couple of weeks after we closed on it, which was awesome. And now we're seeing the buildings opposite being completely rehabbed, and Crack Alley, as it was called before, is quickly being turned around. So that's a really fulfilling, and it's just great to see that we're getting things really right when you look at everything, especially given the amount of extra work that went into it and potentially personal risk.
Yeah, personal bodily risk involved with it, right?
Yeah, potential for bodily harm.
Yeah.
One of the things that I learned in here that sort of validates something that I've already had experience with is that obviously I can just tell by the price you bought this thing at that it was a problem property with a reputation and all that stuff. And it sounds like you learned that sometimes when you're buying a property that's this ridden with problems, it's kind of like you have to get the stank off of it by completely turning over the whole tenant profile, because I've worked through deals where I've relocated the same tenants through a building or a apartment community. And it led to our property not really passing like the father-daughter test, so to speak, when we were trying to, doing lease trade outs with renovated units. So that can definitely be a challenge, especially those ones there's like those sort of repositions from like a C plus to a B type of property where you don't necessarily need to do that. But if you're going from like an F to a C or a B minus, sometimes it's just absolutely necessary. So what did you what's your application for going forward with acquisitions in the future after you learned what you did on this deal?
I think picking up a deal like this again is probably not something that we're going to be considering too soon. That being said, we're more comfortable this time around being able to evaluate what that looks like. We've kind of reworked the way that we explore properties during the due diligence period, paying attention to more variables that we know and are early indicators for some of the challenges we ran into with this building. And it's not just this one in particular. We've got a number of them that we've used to sort of sharpen that skill set. There's not really anything that we would add. We probably would do another building like this, but it would need to be much bigger. It would need to be 100 units.
That's what I was going to add. I think we would. It just have to be larger because the time spent. The opportunity cost of the time you're spending on 30 units versus 100, it just doesn't make sense to. You're not adding that much more time taking on that many more units because you're on site anyways and contractors are there and you get it.
In many ways, if there's an on-site property manager, it would have solved a lot of the issues we had with this building. At one point, we had the security doors for the property that were being rekeyed because we kicked some tenants out, and we realized that these tenants had multiple front entrance keys. They've been giving them away. I met a guest once at the door and who offered to give me his key. He was like, "Oh, don't worry. I had a bunch of these made." And I was like, "Oh my God, I own the building and I don't like that." But anyway, we had all the exterior security doors rekeyed. But then when they came to do the rekeying, they're like, "We need to do this on site." So they just went off with the door. And this is not an area where you can just leave a large apartment building with street frontage with no front door. It's not a good idea. So you just sort of park there and okay, we'll wait until he comes back. And that was not a short period of time.
Absolutely. So you guys are actively at Simcap raising for your fund. Where can people learn more about the fund that you're currently doing a raise on?
Yeah, so the best way to do it would probably be to go to our website, which is simcapholdings.com. There's a little tab at the top that's labeled the Cross-Class Strategy Fund. I do need to put a disclaimer out there that it is for accredited investors. We're not doing any type of general marketing or anything like that. And through that, you can complete a form and you'll do a little self-attestation. If you meet the criteria, then you'll be eligible to look at the material. Our offering memorandums on there, and all our legal documents are also in our investor portal. So we highly encourage anyone that listens to your show that thinks they might meet the criteria, is interested in the Midwest markets in particular. We do target the 6 areas that we're looking at: Cincinnati, Lexington, Louisville, Indianapolis, Knoxville, and Columbus. And we kind of we take a 50-mile radius out and come in. So some of those suburban periphery markets are oftentimes where we uncover really good deals that might be overlooked by some of the large groups that are only they want the center of the city and can carry the negative position much longer than we intend to, in the hopes they can sell it in 10, 15 years. We have a bit of a shorter time on our fund.
Excellent. So definitely go check that out if you're looking to learn more about their fund. And then in closing, before we get into our live Q&A with our live virtual studio audience here, because we don't have much time left, what's your guys' advice for real estate investors that are experienced, that are sitting there and scratching their heads in terms of how they can do larger deals? They may have maybe a couple of duplexes, a handful of single family houses that they have as investments, and they want to scale and bust through that ceiling and go big. What's your words of advice for them?
Mine is always, don't be afraid to leverage your network. So that's one thing we've learned, is it's amazing how much people, obviously if it's a good opportunity, they want to get involved, but if they're a good contact in your network, they're typically more than willing to help you out, whether that's in the form of capital or putting you in touch with folks that, can help in multiple aspects of what you're trying to do. And then learn how to paint a good picture. I mean, if you're already in real estate investing, like, scaling's not that hard. And I feel like the common theme for real estate investors is like, I wish I would have just gone bigger earlier.
So what say you, Josh?
That was the one that I was going to say. It kind of comes back to, you're probably underestimating the size of building that you can handle. Now, I will say that having a strong partnership really helps. If you're doing it on your own, I think it can be quite arduous, and you might be subjected to burnout. But you're probably in a position where you're analyzing 11 units and considering whether or not you can do it, and there might be a 25 unit that's in the same area that there's some type of ethereal barrier that you put up. It's just that, no, that's a different product. It's not. Oftentimes it makes things easier. The numbers just are larger, so they can be scary. But in terms of the complexity, it's not there. Now, there certainly is a threshold where you jump, but up until that point where I would maybe say once you get to 75 units, there's maybe a change. But if you have on-site property management, you have different things to consider, but you also have on-site property management. So it's just, there's a trade-off for positive, for bad. That was my big one, is think that you can go bigger than you're looking at currently.
Another thing in terms of helping scale, think of clever seller financing ideas. Yeah. There's a lot of people out there that are interested and willing in doing seller financing, particularly some of the older folks that are looking to cash out. I mean, there's some tax advantages to not just taking a massive capital gain and doing some form of seller financing. A lot of people want cash flow. They can get that through seller financing. I have a couple people in my network that have started doing a lot of that, and they've had some great success. So capital and inventory are the two hardest things to come by. Well, you can solve the capital piece through seller financing.
Absolutely. And also you don't have to open up your kimono to the banks as well. So
exactly,
that's always helpful.
Yep.
All right, great, guys. Well, I want to wrap it up here. So if you're listening to this right now on Apple, Spotify, wherever you get your podcasts, make sure, if you want to get in on live Q&A, exclusive live Q&A with our esteemed guests like Ross and Josh, you got to join our Facebook group, the Go Big Live Real Estate Investors group on Facebook. You have to request to join, and I'll review, make sure you're not a spam bot, and let you in so you can get access to these episodes weeks ahead of when we drop them, and also get live Q&A access with these guys too. So that being said, if you are listening to this too, please leave us a review and a review. If you think we stink, let us know. If you think we're great, let us know. The reason why we're able to book guests like Josh and Ross is because we have a certain number of reviews across the podcast platforms. They see that people are actually listening to the podcast, so we can, so they can get their story out there to the network. So please do that. It's a tremendous help. It adds a lot of value to our show for booking guests in the future. So that being said, we're going to jump into live Q&A. Thanks for coming on, guys.